Hey folks, welcome to Zoom Out with TouTzuSays, and this is my Q4 2024 crystal ball. Now before we get started, remember that I'm biased, I have blind spots, and this is for your entertainment only. This is not investment advice. Just a quick recap. My crystal ball predictions from January are still doing okay. 9 months into 2024, I changed my first prediction to equal because the US economy has actually done better than I thought. Inflation has, as forecasted, remained sticky. Liquidity has been rising. Geopolitical tensions have not exploded negatively onto the markets, and Bitcoin remains in its uptrend. I changed number 5 as the US dollar this summer finally cracked and seems to have room to weaken. El Nino did not cause a massive US drought this year, so I got that one wrong. Finally, with RFK withdrawing from the elections, we're still left with a nail-biter and likely historic US election, with polls indicating a statistical dead heat and a likely contested outcome. First, although I give this a market impact weighting of only 10%, the US election is only 3 weeks away and is top of mind, so let's delve into what I think. Recent polls indicate that Trump has pulled ahead in the battleground states, and media and Wall Street seem to be betting on Trump winning. If we're to believe the polls, indeed it looks close and may come down to certain counties within these battleground states. But let's not forget that despite the media, we need to pay attention to the actual voting patterns. It looks like Michigan, Wisconsin, Pennsylvania, Georgia, and Arizona have enjoyed high voter turnout, while Nevada and North Carolina has seen weaker voter turnout historically. But regardless of who wins the presidency, for Wall Street and the markets, it's actually more important to have a split Congress, which looks to be the case in 2024. Wall Street prefers that no president or party has the power to make broad sweeping changes. Essentially, the market will tend to rise as long as there's no blue or red sweep. Conversely, the market would likely fall if we ended up with a blue or red sweep. I presented this slide last time, but I think it's important to think through it again. Again, it's all about which candidate can mobilize their base to actually go and vote. No doubt Trump fans are highly motivated, but so are anti-Trump fans. Historically, older Americans, wealthier Americans, and college-educated Americans vote more consistently. Young Americans and minorities are less likely to show up to vote. Although Trump is claiming that Bidenomics is terrible, the economic data simply do not reflect this, as GDP is solid, unemployment at 4.1% is still low, and inflation, though sticky, has come down from 9% to 3%. What I think could be the sleeper motivator for independence is abortion and women's rights and the mental competence of the candidate. Let's see how good my crystal ball is. And as a reminder, US household and corporate net worth have held up really well. The bottom tier of Americans that don't own their homes and stocks are definitely feeling fiscal pressure. But for the majority that do, inflation and the economy are not likely their top voting issue. Net, I'm sticking with my original prediction that anti-Trump voters are highly motivated and more numerous than Trump supporters, and I expect Kamala to win. Regardless of who actually wins, however, we're likely to see contentious lawsuits and contested recounts, dragging the final results out into January or December. I think, however, that as long as the congressional elections can be certified as split, the markets will remain in a bullish trend as supported by rising liquidity. As I've stated previously, I think liquidity is the driving force for market returns. So let's update the global liquidity and stimulus outlook. There are many analysts calculating financial liquidity out there. This one is from Fidelity, and it shows a nice upward right trend. So far, so good. In addition to that previous slide's calculation, a couple of weeks ago, China blasted onto the liquidity train by announcing major monetary and fiscal stimulus to prop up their ailing economy. Their stock markets exploded up but have come down some. Broadly, the stimulus details and amount are still kind of lacking according to some economists, but the important point here is that this is new liquidity coming into the global markets, and there could be more coming. Meanwhile, the rest of the world's central banks have already hopped on the liquidity train, with the European ECB just announcing more rate cuts this week. With US households allocating almost 50% of their money into stocks, it's no wonder that extra money goes into the stocks, and the government can't let a major stock market crash happen, especially during election season. As an aside, another major outlet of excess liquidity has clearly been in Bitcoin. Despite its crazy volatility over the years, it has still outperformed stocks by 5 times. Now, for the US economy, the simple answer is it has been amazingly strong, and even though we're seeing some cyclical weaknesses in some parts of the economy, overall it's healthy, and it's very healthy compared to Europe, China, and Japan. And it's highly unlikely that the US falls into recession in the next year or two, with the exception of major policy changes by a second Trump administration raising tariffs, or war, or unknown, unpredictable events. As I've been saying for years, inflation is sticky this time. We've come down from 9% to around 3%, but the chart looks like it's bottomed and may start rising a bit again. When we look at the physical world economics and layer on geopolitical risks and government stimulus, I think we have the ingredients for some higher inflation. I also find it interesting to note that the highest inflation in the US is in the New England quadrant, while Trump country looks to have relatively benign inflation. Also, wages have been growing and keeping up with inflation, so the net inflation impact on the majority of Americans has actually been manageable. And to top it off, the Fed's GDP prediction model for Q3 is a strong 3.2%, which is nowhere near a bad economy. Some indirect indicators are also useful to consider when thinking about the economy. You can't have a healthy economy without people buying stuff and goods moving around. Rail freight looks healthy right now. And J.B. Hunt, a major multimodal transportation company, just announced better than expected results, and they've been telling people they believe freight volume is normalizing. Meanwhile, in the real economy, inventory levels look like they've bottomed, and there could be a restocking upcycle starting now. This is typically positive for how we calculate GDP. On the jobs front, we saw a big spike in initial unemployment claims last week, but as suspected, this was likely a temporary spike from Hurricane Helene, as this week's claims have come back down. Furthermore, retail sales in September also beat expectations, indicating a reasonably healthy consumer. Although overall retail sales I think will slow into 2025, it's still not at recessionary levels. So, with the US economy still going pretty strong, earnings will likely reflect decent growth. The latest forecast is that earnings continue to grow into 2025, but we're not likely to see the rapid acceleration that we enjoyed in 2023. Magnificent Seven stock's earnings growth rate looks to stabilize around 20% into 2025, compared to the 57% we saw in 2023. Still, 20% growth is nothing to scoff at, and it's still higher than the other 493 stocks in the S&P 500. And don't forget that we have a massive, long-only buyer of stocks in corporate buybacks. Talk about a tailwind for stocks. Nearly $250 billion will be spent on buybacks just in November and December this year. This is very supportive of the stock market. Remember though, regulations require companies doing share buybacks to only execute buy orders after they have made their quarterly earning announcements. We will need to wait until November 1st before the majority of companies can start their buyback programs. This is a wonky chart, but basically it means that there are low concerns about market risk. This means investors are in a risk-taking mode, which bodes well for stocks and cryptos. This fantastic chart shows historical market behavior after US elections. Since I don't see a recession and expect a divided Congress, it looks like we could roll into 2025 with good market momentum. The scenario that I foresee is actually that orange line, which is a pretty strong outcome for the rest of the year and into next year. As an aside, I often get asked about investing in real estate. Here's a great chart that indicates that there's been significant boost in available housing inventory since 2023 in the blue colored states. Home prices in Texas and Florida have indeed fallen as supply has exceeded demand in those areas. Now, despite all sorts of noise regarding the demise of the US dollar, the reality is that it still reigns supreme, and all other countries must account for US dollar availability and US government policy that changed the supply dynamic. The US dollar has been remarkably strong and resilient over the last few years, almost too strong, and it's only saw some weakness this last July. There are many theories of the how and why, but suffice it to say that secret currency agreements, such as the Shanghai Accord, have been made in the past, and I'm confident that they will continue to be made in the future. This bout of US dollar weakness is welcome relief for many US allies as well as competitors, and it could be a cyclical event that the US is blessing. Finally, although it seems 2024 has seen an escalation of geopolitical tensions, especially in the Middle East, my contention is the Ukraine war remains in stalemate. The Chinese have toned down their wolf warrior diplomacy rhetoric and are trying to re-engage with the West. And despite Iran lobbing 600 plus missiles at Israel, the markets have barely reacted. Geopolitical tensions are simmering, but no one will allow it to boil over. And that's my case for why geopolitical tensions are not actually escalating. Sadly, world military expenditures have risen substantially over the last 5 years. And if I were to bet, I would say it would continue going up over the next 5 years rather than going down. Part of the problem is that the world economic pie stopped growing in 2000, causing rising debt and socio-economic unrest around the world. Humans and countries fight for their piece of the pie, resulting in class wars, anti-immigration tendencies, trade barriers, and nationalistic governments. Specifically, China, one of the major economies of the world, has lagged badly, forcing them to reckon with large stimulus packages to respark their struggling economy. In this chart, the black line represents the animal spirits of borrowing and spending impulse, which have making lower highs and lower lows since 2010. That's a bad trend. A desperate country is a dangerous one, so let's hope China can get it out of its economic rut. Otherwise, they will be forced to take drastic and risky measures to hold their country together. As I mentioned earlier, what China says and what China does are often very different. Although there are still plenty of arenas where China and the West continue to clash, China's tone has drastically changed in many economic and political ones. This article on this slide came from the South China Morning Post, which is indirectly censored by China. This means that this article is approved for distribution by the Chinese Communist Party. Case in point, Taiwan and the South China Seas / Philippines are where China continues its wolf warrior tactics. Let's just hope that no military accidents happen that draw in the US and its allies, escalating conflict. Meanwhile, even in the Middle East, things are changing drastically. Iran, via Hamas, caught these Israelis with their pants down. But within 1 year, these Israelis have shown to the world why they are such a formidable opponent. With the three H's, Hamas, Hezbollah, and Houthis, all but decapitated and defanged, Iran's pawns are taken off the board, leaving them weak and vulnerable. At first, Sunni Muslims were probably happy that Shiite Iran was getting a spanking. But now, with Iran hiding in the trenches, the Saudis are trying to decide how they want the Middle East to look after Israel wins. In another aside, we're likely to experience a La Nina this winter with a colder Europe, mixed effects in the US, and possible droughts in South America. Extreme weather has been popping up, especially after the Tonga volcanic eruption 2 years ago. What made Tonga so special was that it was an underground eruption, spewing water, not sulfur, into the upper atmosphere. Water retains heat on Earth, while sulfur blocks heat from reaching the Earth. Historical meteorological data seems to indicate it takes about 3 years for these effects to dissipate, so we have another year to go. So, taking into account all these factors, I remain bullish on stocks through the end of the year and into mid 2025. Rising liquidity and government stimulus is supportive of stocks, though I think that the supply demand dynamic make real estate less attractive this time into 2025. I re-added emerging markets to the investment theme list as US dollar weakness is likely to make emerging markets natural resource exporters much more attractive. With China's stimulus package announced, not only will there be a liquidity boost, but likely also stronger demand for commodities across the board. Meanwhile, even if the US economy slows, I think defense and AI tech are likely to receive continued funding, spending, and expansion. So I still like those sectors. And to try to end on a more cheery note, I think even Goldman Sachs thinks that we'll have a happy Christmas for the markets, forecasting 6,000 plus on the S&P 500 to end the year. Okay, that's it for me. Thanks for watching. I hope at least it caused you to think a little bit. Again, these are just my opinions, which may change tomorrow with new information, but be sure to do your own research and manage your unique risks. I'd love to hear any thoughts or feedback, so feel free to share and contact me with any questions. Cheers.